Will Crabtree here with the Gorilla Gurus Marketing Happy Hour podcast. Today's subject is data, and we're going to make some dark and stormies. I'm here with my co-host, Mr. Michael McKiernan, and our guest today, DJ Rondeau. DJ is a partner and a loan officer at Bay to Bay Lending, so the mortgage industry. We're going to talk about some really fun stuff related to data in the mortgage industry today. How you doing, guys?
Great.
Wonderful. Thank you.
So what we do is we start making a cocktail. I'm going to pour some cocktails here for us. And while we're doing that, I want you to tell us just a little bit about you and give us a little bit of history on how you got into mortgages and what you do.
Thank you. I got in the mortgage industry back in 2007, 2006, when the mortgage industry was kind of winding down. I got in the mortgage industry because at the time, my career had me traveling quite a bit. And it was just not conducive to the things I wanted in life, so to speak. So I went to the mortgage industry, so to speak. A couple of my friends here in Tampa already working in the mortgage industry I'd gone to college with, and they were all doing pretty well. So my first run at the mortgage industry was with National City Mortgage. Did construction loans there for a while. Then they closed down our company, and my entire company went over to Countrywide Home Loans. We were there for about a year and a half. And when Bank of America came in and acquired Countrywide, I decided that I did not want to work for Countrywide or Bank of America, basically. Mm-hmm. So I came to Bay Lending, my current company. I've been here for a little over 13 years now. I'm a partner. And I really like helping people buy homes. It was kind of a natural transition for me because I was in the restaurant and hospitality business, but I had a background in accounting and business management. So the mortgage industry.
Is that what you went to school for?
It is. I went to school at USF for accounting and business management. I'm an undergrad in accounting, which I really use none of these days, quite frankly, in the accounting industry.
I think a lot of us have that with school.
Right. I just had to do it. So I was almost finished with my master's, and I finally realized that I was never going to be a bean counter, and I was never going to be an accountant. So I pretty much pushed that to the side. I can always go back and finish my master's if I wanted to, but I've been in the mortgage business this long now, and it's my passion. It's what I like to do a lot. I enjoy meeting people, helping them through their process. Everybody's always got a little different situation. So it's like every scenario is different than the one you've seen before. Mm-hmm. You know, the terms of what they're doing, the rates, loan amount, everyone's specific situation is different based on their background, income, assets, credit, loan type, property type, everything. So yeah, that's how I got in the mortgage industry. That's how I've been. And then what I do right now, I basically work with real estate agents, attorneys, CPAs, past clients, referral partners to qualify people for home loans and then help them obtain different types of financing. Don't waste any of that, Will.
I know, right? My pour is off today. I'm dribbling all over the place.
Monday. That's what most of my job consists of. And then helping people understand the credit process. Credit in America is a little bit confusing, to say the least, to a lot of consumers. So most of my day consists of explaining people loan guidelines, how to fix credit, etc.
Sure. Yeah, I always need somebody like you. I have no idea, and really, as long as there are people like you, I don't care to learn.
It's confusing at times, for sure, especially just like anything, constantly changing markets. The rules and guidelines are changing daily in the mortgage industry.
So I don't want to go too far down the rabbit hole about mortgage lending, right? But I think something that is important for people to understand, that is something that I don't think most people understand, is the different types of loans. So you got your FHA, you got your conventional, you got your VAs. Can you give us a little bit of insight as to the difference between those loans and what type of person qualifies for which type of loan?
Absolutely. I'll start out with the first one you brought up, FHA. FHA mortgage is a federal government-backed mortgage. It's insured by HUD, and these mortgages have a max mortgage loan limit in most areas in the country right now. The Hillsborough, Pasco, Pinellas, our local region, our local loan limit's 356, 362. So that's our local loan limit for FHA loans. So if you're going to be purchasing a property, let's just say greater than 370, you're kind of running out of real estate there with regards to the 3.5% down FHA loans offer clients. FHA loan also offer clients with lower credit score, higher debt to income ratios, borrowers who require non-occupying co-signers, anybody that's got a little bit different situation, that's where FHA really comes into play. Lower down payment. They offer a split mortgage insurance option where you pay part of your mortgage insurance upfront and then part of it monthly, which brings down your monthly payment. A lot of people, a mortgage is how much money down, what's my monthly payment? Then you've got VA loans reserved for active duty military veterans or spouses of disabled veterans or deceased veterans. These loans offer higher loan limits than FHA, still a government-backed mortgage, but higher debt to income ratios, lower credit scores. These are really ideal mortgages. The best mortgage out there, in my opinion, is a VA loan if you can qualify for it. Zero down is the biggest benefit.
So VA loan, they don't have to put down a down payment at all. And I know there's a lot of really aggressive targeting towards veterans and doing refis right now because the interest rates are so low. So if they bought their house 10 years ago, doing a refi right now with the interest rates the way they are now, they're going to save a boatload of money, maybe pull out some equity and do some other really cool stuff.
Absolutely. You see a lot of target marketing like that for VA home loans specifically, because for a VA home loan, there's no income, no credit validation. All they have to do is be current on their mortgage. And that's it. They can do a rate and term refi. It's called an IRL, interest rate reduction loan. These are ideal if you do have a high interest rate, but maybe you can't prove your income now or your credit score is not stellar now. You just take advantage of the IRL. Just straight refi, no cash out. It's a pretty good option. If you're looking to do cash out or you're looking to change the term of your loan or increase your payment, a lot of people right now are going from a 5% 30-year fixed rate loan they got 10 years ago or 15 years ago, if you will, and they're going down to a 10 or a 15-year mortgage, pulling out cash and still lowering their payment, because the rates are so much lower now. So the benefits of the VA is just a lot more people qualify for them. There's a lot of VA loans, and we see a lot of targeting for VA loans in this area because you have such a high concentration of veterans here. A lot of veterans hospitals in the area, MacDill Air Force Base. You just have a lot of VA loans here per capita, if you will. And then there's a couple other loans, conventional mortgages in the Tampa Bay area. Conventional loans go up to $548,250. $548,250. That's the max conforming loan limit in this area. And when you go over that $548,250, that's when you're dealing with jumbo mortgage terms, higher rates, more difficulty qualifying, oftentimes higher credit score requirements and higher reserve requirements. Reserves are what they call assets post-closing, so assets that you have available for reserves after the deal were to fund. Kind of a financial stress test, if you will, in the mortgage industry. And then lastly, there's what they call non-QM loans. These are probably the biggest hot spot in the mortgage business right now. They're loans for self-employed borrowers that may not show all their income or may be able to take advantage of certain tax benefits by reporting their income a certain way where they wouldn't qualify for, say, a $600,000 or $700,000 loan. So we've got debt service coverage ratio loans, which means that the property itself pays for itself. The loan's approved. It's like a no ratio loan, they used to call them. We have 1099 only loans where they only look at your 1099 and they'll give you 75% of that 1099 income for qualifying income purposes, which is pretty liberal. If you ask me, most business owners write down more than 50% of their income. And then there's bank statement programs. There's a bunch of different loan programs out there right now for borrowers who don't really report all their income to the IRS, mostly self-employed borrowers.
That don't report all of their income to the IRS.
Correct. When I start explaining to the consumer or customers, so to speak, about the non-QM loan products, and I start explaining the rates. The rates are about a point higher than a conventional loan. And they go, "Oh man, that rate's high." I'm like, well, you either pay the lender or you pay the IRS. And they kind of look at me and kind of snicker. They're like, got me. I'd rather pay you an extra 1 point than pay the IRS, but I got to pay them. So it's and
if anybody from the IRS is listening right now, I did not do one of these loans, by the way.
What IRS? Yeah, I didn't say that.
Well, no, that's awesome. And that's really interesting stuff. That's a lot more than even what I knew. I like to think that I know quite a bit about the mortgage industry. I've bought several houses in the last few years. I move way too much. I'm not in my forever home, but I'm definitely going to stay where I'm at for a good while before I try to buy another house. But mortgages fascinate me. The industry fascinates me. Home buying fascinates me. Mike's wife is a realtor. No, she's a broker now, right?
Yeah.
She's got a broker license. So we've been doing some marketing for her, and we deal with so many realtors on the printing side. It's ridiculous. But I have some really interesting programs that I've come up with for the mortgage industry for marketing. Because ultimately, you guys are handcuffed in the way you can market. Outside of the things that you mentioned of working with realtors, working with other referral programs, when you're doing your actual marketing, you can't demographically target because it's considered discrimination, right?
Absolutely.
And this is a recent thing that's happened or that's become enforced. So if you're trying to sell VA mortgages, for example, you can't go online and target veterans. You have to advertise your VA loans to everybody. Not everybody qualifies. So that's like the bad part about all these laws and these non-discrimination and inclusive things is that it really prevents you from being able to target and bring the message to the appropriate people without sending it to everybody, which is ostentatious. It's ridiculous.
It is ridiculous. Or I guess I see the point. I guess I see the overall point in it.
I mean, I do too. I get it. I think that there's something to it, but from a marketing guy standpoint, it's annoying.
Why is it my grandma has so many AARP ads on in her mailbox? I don't have though. Are they discriminating against me? I don't get the AARP ads.
They are. They're discriminating against you because they're marketing by age. But your mailbox is one of those places that you can actually indiscriminately target people however you want, which is sort of the back door of how the program works. How's the cocktail, guys?
Fantastic.
Is it good?
It's really good.
All right.
Bartender's got a strong wrist.
This is my favorite so far.
It's definitely strong, but I like rum, so I like rum just
Straight
real
rum.
thick and then like a splash of Coke. So I'm doing all right with this. Well, with that, why don't we go ahead and head to the lounge and we can talk a little business and see if we can wrap our heads around some different stuff.
Rad.
All right.
Sounds good.
So we kind of started to talk about this in the other room, and this is sort of the topic of today's conversation and podcast is data, right? So data aggregation in its simplest form is buying lists, which is something I've been doing for many years associated with direct mail. So when I'm buying a list, I can ultimately filter it however I want. So I can say I want people with a 650 credit score that rent, that have 2 kids, and an average household income of $150,000 or more, right? So we can target however we want to target. So you're talking about the mailbox and the AARP. When you're sending mail, there's no discrimination, right? We can target however we want to target. But the cool thing is that we can take those same lists that we buy to send direct mail, and we can actually import them into Google. We can import them into Facebook. We can import them into other digital platforms and then serve ads. So where you're restricted on being able to serve ads or filter by demographic through those platforms, we kind of backdoor it and we use the data list that we've already created through the mailing list and then import that in and then serve the ads that way.
Genius. Genius. Getting around the rules a little bit, but I like it.
Yeah.
So you're not specifically using them as an aggregator, so to speak, of the service provider is not the one that's doing it.
Right. Well, I have several different organizations that we can buy data from, and then those organizations actually go to different databases. So there's consumer databases. I mean, we can get databases, or we can get access databases to doctors' licenses. So we can get doctors' home addresses. We can get, like, we just did something for a police department, which was really hard data to get because obviously it's very protective, right? Like, you don't want somebody to be able to go and find out where the cops live. So
Absolutely not.
we had to jump through a bunch of hoops to be able to get that data, but we did. We were able to get police officers' home addresses, and that came from a very specific database. So myself working with representatives at these organizations are actually doing the aggregation and looking at the different databases to figure out where they can get the data and how they can get the data.
Interesting. I never knew that it took so much to get the data that I'd buy. Because I've been buying lists for years as well. I mean, I haven't bought lists in the last couple of years because business has been good and it hasn't been focused on like refinances. But when I first got in this business 10 plus years ago, buying lists was part of my every month job. I mean, I was this company, that company, this company, print companies. People would come to our mortgage companies and sell the leads to us. And then our mortgage company internally had sources where we'd get the leads from, our own clients, our own portfolio retention databases. Like that's what we would kind of focus on. So we would do at the time, we would focus on VA riders. We would just have title companies pull all the local mortgage closings or mortgage closings between, this year and that year.
Mm-hmm.
When we knew rates were high, we'd have them pull every single VA loan rider and have them send it to us. So at that point in time, that's how we would get our data. It'd be the title companies. Title companies didn't provide us all of the VA loan riders and it'd be easy.
Mm-hmm.
But obviously it's a little harder to market these days.
Yeah.
Especially the VA specifically.
Well, we could do those too. So we can get VAs, we can look at house closings, we can look at how much the house sold for, we can look at, the average interest rate of when that house sold, we can look at their average household income, and then we can even look at whether or not they have an email address available too. So that's another thing in data buying now, is that we can get the email address, which if you've got the email address, then it makes it easier to match it into the other digital platforms. You can still serve ads with just a name and an address, but the matching process is easier if you've got the email or the phone number. It's fun stuff.
Yeah.
I like it. It's nerdy.
But it's
do you
about
go-
efficiency.
Yeah.
I was going to say, and how do you see the data that you guys already receive and use and mine, so to speak, for like the real estate industry? How do you see that correlating? I guess you can use some of those things from a valuation perspective as it relates to like the mortgage value. At the time the mortgage was taken out 4 years ago, it was $400,000. Normal amortization puts you at $380 on your loan amount, or $385. We now think the home is worth $540. Like you guys almost have to be able to do, maybe not you guys, but like from the real estate agent perspective, you almost have to be able to market to realtors and say, hey, we've got this list of homes in this area where we feel everyone has between 150 and 250 grand in equity. I think that these would be easy clients to door knock, or easy clients to send postcards to.
Yeah.
Listing postcards or things like that. Or if you're an agent in that area, maybe I just sold a $750,000 house down the street from you. I could do the same for you and your wife, or you and your husband,
Right.
Well, the real estate market right now is just bananas, right? I mean, homes are skyrocketing in value. The housing market, not just from purchasing homes, but even renting in Tampa Bay right now is crazy. So, it's kind of feast or famine. So I didn't even honestly think about going to the realtors and be like, hey, you should use this. I've always thought about it from the mortgage industry standpoint, right? Because there's so little that you can do from a marketing standpoint outside of direct mail or the referrals or working with the realtors, the stuff that you guys are doing, which you have an established reputation. People are just coming to you and you're getting those referrals already. So you don't have the issue, right? Or you don't have the necessary need for something like this, where the realtors probably would have a much greater need of, where am I going to get clients? How am I going to get people to sell their houses?
Increase scrutiny and a few more rules. Mm-hmm. So it's something that, being able to do this, we figured it out.
Mm-hmm.
And then there's probably a few more challenges that we'll have to address. But I think it's that way with any group that has regulation.
Right.
So, and both you and I come from a long background of working with clients that are under regulation scrutiny. So just making sure that you can stay within the lines and then you get creative.
Right. Or you stay in the gray area and get creative, because I'm sure there's definitely some gray area to what we're talking about here. And I think the gray area comes from, if you were to approach me and say, I want to target these specific people, then we would probably have a problem. But if me as a marketing company says, I think these are the people that you should be talking to, and let us take care of that for you, I think that's kind of where that gray area lands, where you're hiring a marketing agency and the marketing agency is driving traffic to you, and it's that easy, or it's that simple.
Absolutely. I think given the demographic of this market in Tampa with regards to mortgages, I think like you were hinting at in the other room about why you see a lot of VA targeted advertising, it's just the higher per capita, veterans in this area. Also, I'll call it out, government loans are priced really well.
Mm-hmm.
So on a VA or an FHA loan, if you're a broker or some form of lender, profitability on these loans can be extremely high.
Mm-hmm.
In addition, I feel, this is just me and my own 2 cents, I think some of the lenders that choose to focus on veterans, they know what they're doing. A lot of the veterans that have these home loans, they're seniors, a little easier clientele to work over, so to speak, with higher rates or higher fees. And oftentimes and this isn't a plug for my business at all, but a lot of times when I do steal a client from another VA mortgage company, their rate was considerably higher than mine. Their fees were considerably higher. And I'm like, what were they doing?
Well, feel free to plug your business.
Looking at like their fees and their rate sheet, I'm like, I couldn't even charge a high of a rate, and I don't even know how they can charge that much in fees. Like they're charging 2 or 3 points in fees, and the rate's 3.75, and the client comes to me, and I'm like, you're charging the $500 underwriting fee, and your rate's 2.75. I'm like, I don't know what the other bank was doing, and it's just, I know the reason that a lot of people target VA. You know, you got people with mental health illness problems. You got a lot of seniors. You just got, I think, the easier targets, so to speak. Mm-hmm. And I think that that's the reason a lot of people target. I also think that what I said in the other room is still true. I think there's a lot of veterans in the area. You got a lot of VA hospitals in the area. And then a lot of retirees in the area as well. You know, Sun City Center, most of Pinellas County. You know, you've got a lot of retirees down here with a lot of VA home loans.
Yeah.
I was going to ask you guys a question about the data, but I forgot what I was going to say.
Well, you're thinking of that. I think it is probably important to note, though, that a lot of where we feel comfortable in what we do is looking at the spirit of the law. That like we're not cutting out the diversity, inclusivity. Like we are definitely not trying to keep people from getting offers.
Absolutely
We're
not.
just honing down the people that are actually right for the offers, and if anything, not wasting anybody's time.
Right. Well, I mean, when you're talking about marketing dollars and how you market any business, right? You have to be as efficient as possible and get an ROI. So, you know, if we were marketing an FHA loan, we would target a lower household income. We would target, again, renters or people that have a current mortgage that's on the lower side that qualifies for an FHA, versus if we're marketing jumbo loans, right? And we're going to go for higher income and you know, it has nothing to do with age, race, or anything of that nature. It really comes down to whether or not they qualify for the loan and how we reach the people that qualify for the specific types of loans, which is one of the reasons why I wanted you to explain the different types of loans.
Absolutely.
Yeah, so we're not enabling anybody to push. We're giving those consumers an opportunity that they might not have seen.
Mm-hmm. No, I agree with that. And I think that the spirit of the law and the spirit of what they're looking at by the CFPB and RESPA and Truth in Lending and everything else that the government's trying to protect people, it's not that they're trying to keep loan products out of certain people's hands. They just don't want banks not marketing to lower demographic communities, for instance, or maybe certain ethnicities, communities, so to speak. They don't want banks like taking those areas, or credit unions, or not just banks or credit unions, but anybody, Amazon, whoever's going to market.
Right.
They don't want them taking them out of the pool.
Right.
And I get that part. I just don't know, like you said a minute ago, whenever you take a look at a business and how business has to run, if they have higher costs, then the consumers end up paying a higher price.
Right.
So as any company, why would you want that company to have to market to everyone if only a certain portion of the marketplace or segment of the marketplace is available to consume your good or consume your product? So,
well, and in the digital landscape or the digital marketing landscape, the really the two major qualifiers or the things that remove the demographics are housing and employment. So if you're marketing employment or you're marketing housing, then you have to go broad. You get all the filters and all the demographics taken out of everything. But if we were marketing printing, for example, we can target anything and everything. I mean, you can look at
who's got 8 kids and a chinchilla. We got you.
I guarantee you there is a filter for chinchilla lovers. I guarantee you there is. But I mean, it's infinitely granular on how you can target and how you can market and demographically separate based on behavior and actions and search intent and websites that they've gone to and everything. It's all calculated and it's all accumulated constantly. So when you think that your phone is listening to you, it's really not listening to you. It's just what you've been doing on your phone and what you've been doing on your computer. And that's why things start to, feel like, oh, Amazon's listening to me.
And even places you've been.
Yeah. But I understand and I appreciate the need for the rules, because if you don't put the rules in place, then people are just going to go crazy. And it does leave the door open for people to abuse and do things that they shouldn't be doing. But again, being the type of marketing company that I see us and how we like to do things that are a little off the beaten path, this was a way that I figured out of how we can actually get a little more granular and still be in the digital landscape without having to market everything to everybody.
And you love the granular.
I do like granular.
Stands you apart from your competitors when you can get data other people can't get, or when you have a creative idea that other people don't have.
Yeah, for sure.
Yeah. Then the competition will listen to this podcast and
Right. Did I give away too much of the farm?
and that was the secret sauce. But well, and for us, and for you, and for anyone, it's not like the data aggregation is important. Getting the data is important, but it's what you do with it.
Right.
Like just having the names and addresses and, email addresses and what have you. Well, if your message isn't compelling, if you aren't providing something better than the competition, then it's pointless.
Right.
I agree with that.
So what else are you doing for marketing right now? Are you doing just referrals or?
No, we're doing some advertising with a local real estate advertising publication called Tampa Bay Real Producers. They're advertising to real estate agents and really anybody that wants to pick up the magazine Tampa Bay Real Producers. But Tampa Bay Real Producers, the way that their magazine kind of functions and works is they advertise and basically have cover photos and like cover layouts inside of like 3, 4, 5 pages of different agents. And they might be like top producing this or top producing that, or being really great at being a team leader, or might have all these different things. But in order to make the magazine, you have to be amongst the top 500 agents in Tampa Bay. Right now, based on last year's sales, I think that's around like 12 million.
Oh,
so
wow.
if you're an agent, you do over 12 million in sales in 1 year. That's about $1 million a month. About, whatever, 150 to 200 grand a year in revenue. You can make this magazine, so to speak. So we're one of their advertisers with them. We're at all their functions. We're trying to market to and brand ourselves with like luxury, so to speak, higher end agents, and agents that do good volume. As a mortgage loan officer, we really want to kind of be in there with all the agents, so to speak. So when a listing agent gets our pre-qual letter, they respect us, but you don't really get most of your business as a loan officer from a listing agent, because the listing agent's not working with the buyers. It's the buyer's agents that have the buyer's ear, if you will, and have their respect, and riding around in cars with them, having lunch with them, coffee with them, looking at houses with them. You have an opportunity to earn their respect. So, where I try to focus on in terms of my business is developing relationships with and working really hard for high producing or buyers agents that work with either a lot of buyers or good buyers, selective buyers agents, so to speak. Not just a buyer's agent that'll go beat down any door, but buyer's agents that work with, cooler buyers or easier buyers. Or sometimes you've got certain buyers out there that are just really difficult to work with. I don't want to work with agents that have those types of buyers. You know what I mean? I want to work with agents that have easier buyers, not so much easier, just more cooperative.
Right.
People that really want to understand and listen and go through the process. And if they ask you questions about rate, and I try to explain to them the differences with rate and how it impacts their origination or their closing cost or their monthly payment or how the PMI is calculated. As you go through and you have to explain to the clients the nuances of these loans these days, there's a lot of moving parts. And, these days with like conventional private mortgage insurance, the way that they're reforming that, insurance reform, they just redid all the flood maps here in Florida. There's a lot of things changing in the real estate industry and mortgage industry that are like constantly changing, just like tax law. The real estate contract in November changes. Our state of Florida has changed the real estate contract to, pretty big magnitude. Actually, they've changed and I'm not an attorney, by the way, or a realtor, but under the financing portion of the brand new FAR bar contract, it now defines a loan approval as not being a loan approval or a loan commitment, as they use, until the appraisal's back.
Mm.
Okay. So there's 2 classifications of approval and approve without the appraisal. And until you have both, you don't have a loan commitment. Because there's so many, in the last year and a half since COVID and the virus started, basically, there's been such a backlog in service providers. So like surveyors and appraisers, anybody has to get out and actually do the work. Everything there, shouldn't say everything, but there are a lot of delays in those 2 categories due to either weather, sickness, appraisers were getting sick for a while. Surveyors were getting sick. People that work in the office of the surveyors and appraisers were getting sick, and it just put everything to a really big backlog. In addition, when the mortgage meltdown took place, a lot less people really want to be an appraiser or be a surveyor, as that is their profession. So there's less people doing it. We've never had the volume that we have now in terms of the numbers of closings. And so I saw this coming the last year and a half. A lot of loans have been conditionally approved. And then once conditionally approved, then they go to the appraisal. And the appraisal takes 2 to 3 to 4 weeks, and it comes back short. So when you're outside your financing contingency, the seller is kind of caught with their pants down. Buyers are caught with their pants down. Appraisal come back short.
So
buyers don't have the money to cover the gap. Sellers are kind of in a bad spot. And so like Florida Board of Realtors and the Florida the Florida Bar of Attorneys, I know that they have had a lot of input on this and changing the contract. And that's going to change, I guess, your wife's industry and my industry as well.
So the change is going to be that the loan isn't actually confirmed until you have the appraisal. From the FAR bar contract perspective, that's the way they're putting it. They're no longer accepting the loan commitment without the appraisal. They want them both if you want it to be valid. Gotcha. Now, technically, when you're doing a letter of intent, right? So I put an offer in on a house, I do an LOI, and with that, I have an appraisal contingency, right? That's how they're always written. And then you have your grace period. You have the certain amount of time that you can do your appraisal, you can get your inspection, you can do all of that stuff. Are you seeing that they're extending the timeline on the LOIs because of the backlog? So they're keeping things
They're making it shorter, actually. There are a lot of sellers in this market, they want the buyers to sign contracts with no financing contingency or no inspection contingency.
Well, because it's a seller's market right now, and people are just...
No appraisal contingency, like some of the things the sellers are asking people to do right now. I see buyers that are signing contracts. I see contracts come across my desk all day, every day that say, oh yeah, we'll pay 40 grand above appraised value. And I'm looking at their finances. I'm like, you're gonna have to liquidate everything out of your 401k to do that. I mean, you could technically do it, but this is gonna get rocky. But people are getting very bold right now because they're looking at finding the home that they want. Let's just call it like Tampa, St. Peter, Clearwater, or driving an hour, paying more for an affordable home, but having that hour-long commute to get to Tampa, St. Peter, Clearwater. You're either paying a lot to live in these 3 local areas, or you're driving to one of the remote counties, you know what I mean? Maybe Citrus County, Pasco, Polk, down to Manatee County. Even Manatee's getting pretty expensive right now.
Yeah.
So you've got...
The metro area, we've become a real city.
We have.
So are you seeing contracts falling apart because people are doing these no contingency contracts and then they don't have the money to back up the extra? I've been hearing stories of people just offering stupid money over what it's appraised for, and it's happening.
I'm seeing people spending their life savings in their retirement and getting gifts from family members to pay above list price. I'm not seeing pushback. I'm seeing the opposite. I'm seeing people going outside of their norm and getting aggressive and getting downright desperate, doing things that I can't advise people to do, and quite frankly, I don't think I'd personally do.
Right.
It's like watching, what's that, HGTV channel, where you're like, oh, this guy, he raises ferrets, and she has an Etsy show of, she makes popsicle trees or whatever.
Their budget's $800 grand.
No, their budget is $1.99 million. Like,
where did they get that? What lottery did they win in what state?
Yeah. Right? I just think everybody on that show is like just really good at dealing drugs under the table.
Is that what's going on? It has to be.
I'm like, yeah, the ferret farmer? Dude's totally selling weed.
You got chinchillas and ferrets going on. And
I'm working all the rodents.
We're going to get to squirrels and raccoons before the end of this thing.
I watched clients come to my office, not anymore really because of COVID, but for years. And even when I talk to them, they're always talking about, oh, I was watching Flip this house, or I was watching Flipping Vegas, or I was watching this. We should be able to do this and do that for about 17 grand. And I'm like, oh gosh. I'm like, you need to stop watching HGTV. Some of these people that want to come in like, oh, we're interested in a fixer upper. A lot of times people come to me and want to talk about mortgages for properties that are considered fixer uppers. And the problem is, in order to get a mortgage, you need to be able to get insurance. And if the property can't pass, basic 4-point inspection, you're not going to get insurance on it unless you're doing like a construction loan or renovation or rehab loan. Those loans have higher closing costs, higher interest rates, take longer to close. More elite borrower really qualifies for those. So then by the time you take all that and factor it into play, yeah, you can technically renovate a home or do a rehab loan, but they're a monster. You know what I mean? They're just a real bear. You know, if you've got normal closing costs on a normal loan and your rate's say 3.25 on a construction loan, it might be 4. Your costs are times 3 or 4. So just HGTVs out there got people thinking like they can do a lot of things they can't. You know how much it costs to renovate and fix and rehab homes. It's always twice as much and twice as long.
Exactly. Triple. Especially when you're talking about commercial. Oh man. Well, the mortgage industry is like I said, it's always interested me, and it's I feel like right now it's got to be the Wild West with everything that's going on in the housing market, especially here in Tampa Bay. And I know that we're not exclusive and that we're not the only place that this is happening in the country, but the number of people that are moving here at the rate that they're moving here, the rent prices have doubled in a lot of places. Is even tripled in a lot of places. Home values have increased in some neighborhoods by 50% in the last year and a half, 2 years.
Yeah, I mean, it is, my neighborhood is blown up.
Insane here right now. So I'm envious of you. I'm sure you're doing well.
Yeah, we're busy. We're helping a lot of people right now. But yes, things are good. We're busy. Rates right now are going to start rising. And we saw that last week, the day that they came out and spoke. That day we lost 75 basis points in the market, and the next day we lost another 40.
Oh, wow.
So in 2 days, we lost almost 120 basis points in the bond market, which is pretty significant.
And 120 basis points, that equates to like what, 1.2%?
Correct, 1.2 in cost on a loan. So as an example, a $400,000 loan last Wednesday might have cost you $0 at a par rate of 3%. Today, that same loan at 120 basis points over the $400,000 loan amount would be like $4,800 in loan costs. I'm sorry, $4,400 in loan cost more.
Oh, wow.
For the exact same loan today, pricing wise, versus last Wednesday.
Okay. And that's something that the consumer winds up having to pay, correct?
Correct. Because the Federal Reserve came out and started talking about they're going to be raising prime. And traditionally, when the Federal Reserve does that, or the federal overnight funds rate, traditionally when they do that, they raise it by either 25 or 50 basis points. We lost 115. I think it's a lot more. It's more than just them raising prime. I think it's a signal of what's happening, and that is inflation. Mm-hmm. You know, the inflationary pressures that we're feeling right now are huge. And the problem that you have now is if they try using fiscal policy to raise the federal overnight funds rate too fast, businesses won't be able to borrow funds overnight, and you're going to slow down the economy. So then we'll have what some call stagflation. You know, you'll have crazy values, and the value of the dollar will be super high, but no one will be able to afford to pay for anything. So there's a fine line these guys are going to have to walk. And as we see the guards change, so to speak, between the White House and what's going to happen now with the Department of Treasury, I think that we're going to see some things get shaken up a little bit. And I think that's the reason the bond market kind of felt like it did. Also, cryptos have fallen pretty hard since last week too.
Yeah.
So I think people just are starting to sense it. I think people are starting to feel that the stock market's extremely ripe, if you will. And then, you know, with everything that's happening, home values are definitely not slowing down. But, you know, if there's going to be a retraction of values, because it's a question I hear every day, in my humble opinion, I feel it will first be in the outlying areas, the communities outside of Tampa or Tampa St. Pete metro area, those communities that have, you know, a lot of builders doing a lot of new construction. They might have 800, 900, 1,000 homes in, you know, a couple communities. When values start coming down, if that happens, it's going to be in the more remote areas before it happens to, you know, Tampa proper,
sure.
Clearwater, St. Pete.
So I've been speaking to some people in banking, and the general consensus that I've been hearing from a lot of people in that industry is that the economy isn't leaned against or isn't reliant on the mortgage industry or isn't based on home values, where the reason that we had the crash in 2008, 2009 was because everything essentially was propped up based on property value. Where now the inflation and everything that's going on now is because of the amount of money that they're pumping into the economy. They're printing money faster now than they've ever printed money. They're putting more money into the system now than they've ever put in at a faster rate. So what I've been hearing is that home values ultimately aren't going to go down. They may level off or plateau, but they're not going to decrease. We're not going to see a big crash where if your house is worth $350,000 now, it's not going to go down to $200,000 overnight like it did in 2008, 2009. You might see a slight correction, but I think and this is what I've been told, things will level off a little bit. But you said retraction, which is why I'm asking.
That's exactly what I'm saying. I'm saying that the retraction, if at all, you're going to see, it's going to be in the new construction area. And it's going to be in the remote areas. The
where there's not a built-in demand as much as there is in the city of like
North Zephyr Hills. I'll give you, for instance, North Zephyr Hills maybe, or Waimama, Sun City Center, some of the further areas from
where they're building like Tampa. Crazy.
Correct, where builders have 700, 800, 900 building permits approved. You know what I mean? That's because when the demand stops, the builders are going to be stuck holding the bag with all these homes that they just built.
Right.
They're going to have to lower their price to sell them. That's where I'll see the retraction. Like you said, remote areas, yes. Downtown St. Pete, Old Northeast, Snell Isle, Davis Island, Harbor Island, Palma Sea, Hyde Park. I don't see these areas coming down. I don't specifically, since they brought CENTCOM and SOCOM and they have all those 6-figure salaries down there at McDill now. I just see too much of a demand. I do see, like you're saying, if you're going to see the values come somewhere, it's only going to be in the remote areas, in my opinion. You'll see them plateau a little bit here. I just think, if you think about it, values right now, or a year and a half ago, before it jumped this last time, about a year and a half ago, values were where they were at in 2006 at the height. So now if we hadn't had that big retraction, we really would be right where we should be, I think, right now, value-wise. That being said, I think that the reason the market crashed the last time was because, there were artificial values. There was no regulation in the appraisal industry and then the lending industry. When I first started doing this, I pick up the phone and call my appraiser, tell him the value I needed, and he told me whether or not he could hit it. If he couldn't hit it, I'd call another appraiser. That's what we were taught to do. Talking the truth, like that was it. Branch manager told me everyone gets a loan. We got no doc loans, stated income loans, that's just what we were taught when we first started doing this. Now it's a complete opposite. You know what I mean? The reason the values fell before is because people were bartending or stripping or doing whatever they were doing. Could be a clerk somewhere, and they were stating their income. You know what I mean? Stated income loans. They were hoping that the values went up before they even closed on the house so they could sell it and flip it. All these liar loans were out there. So just propped up the values. Fake income, fake assets, fake values. Eventually somebody's going to stop. And when they did, I worked for a construction lender at the time. Half the homes that were under it weren't even built. They didn't even start building them.
Oh, wow.
These appraisers were out working in collusion with the builders and taking pictures of property A and saying it was properties C, D, E, and F, just so they could advance all these draws and all these jobs, and they weren't even building the homes. So there was just so much collusion and so much corruption and everything that was going wrong back then. That can't happen anymore.
Right.
The industry is so regulated. People are spending real money. People have real income, real credit. You can't state your income and credit anymore. You used to be able to state everything. Now you can't. So it's just, I don't see values falling for that reason. People are spending their hard-earned money. These loans are being, 99% of them are being prudently underwritten. Really, really strict underwriting based on what income people report to the IRS. So I don't see values falling. I see this being a very strong real estate market. If anything, maybe a small plateau in the next year or two. But even that, I don't see really happening. Too many people want to be here because of our business-friendly practices and our tax-friendly practices.
And our teams are winning.
Our teams are winning. Best governor in America. We got this governor down here that keeps everything open, even though he shouldn't sometimes, but it's good for business.
It is good for business.
It's good for business. And, he gets hated on and people talk trash about him, but it is good for our businesses.
Yeah. Well, this podcast kind of turned into more of a housing and mortgage, but we have a mortgage guy here, which is perfectly fine, and it's still all data, right? It's still all information and useful, and
maybe even a little sexier than data aggregation.
Yeah, I think it might be a little sexier than data aggregation. Well, guys, thank you so much for joining us on the Guerrilla Gurus Marketing Happy Hour. DJ, it was awesome having you. I learned a lot of really cool stuff and more information than I had before. And McMike, it's always great to see your wonderful face. DJ, if somebody wants to get in touch with you to talk to you about mortgages, what's the best way to do that?
You can do so. My email address is djrondeau@betabaylending.com, or my company website is betabaylending.com. My number direct is 813-480-6077, and DJ Rondeau with Beta Bay Lending.
And I've never actually gotten a loan through DJ, but I've known DJ for several years, and I know a lot of people that have, and I'm confident that he will take good care of you if you need to get a house.
And now that you talk to us, I'll understand what people are talking about. And thank you so much. I learned a lot.
Thank you, Mike.
And enjoyed it.
Yeah. We'll see you guys next time. Thank you.
Thank you.